Good evening, ladies and gentlemen. Well, tonight is quite an exciting evening. We're going to be looking at the UK market. Now, the UK market, there's a lot of good news coming through. There's been a tremendous amount of bad news. And the question I want to look at tonight, is it a crisis, is it an opportunity, or is it both? What does it mean to you? You know, when I read through the reviews of what people are looking for this evening, they're looking for information, they're looking to understand the property market, they're looking how to get a mortgage, and then ultimately they're looking how to take advantage of the opportunities that are available today. So what I want to do is I want to crack right on, get straight into it, and really be able to assist you in terms of understanding the market and both, most importantly, making educated decisions to be able to take advantage of that market. So that is really what tonight's presentation is about. Right, so the very first screen that I want to take you to is a little bit of administration. You'll actually see on your screen at the moment, you've got a blue screen, which effectively is what is being shown on my screen. It's my PowerPoint. And then on the right-hand side, you've got your controls. So for those of you that haven't used a webinar before, you'll basically be able to change your audio settings. You'll be able to raise your hand here. So I can then see it's like sitting in a venue, and I can see you put your hand up to ask a question. Or to be honest, you can actually write a question there, and I'll see it pop up as a question having come through. And I'll then be able to answer that question. If it's something that I can answer straight away, I will. Otherwise, I might wait to the end to be able to go through all the answers. So hopefully that gives you a good idea of how these webinars work. And, you know, you must bear with me. This technology is brand new. It's certainly very new for a lot of South Africans. And it is something that we're going to get, you know, better at. But I think the most important thing, this, ladies and gentlemen, is the way of the future. This is how information will be communicated. So let's move on to the UK property market. You know, this year was a headline in one of the newspapers. I've got hundreds of them sitting here in my office at the moment. The one thing the British press love to do is they either love to talk up the market or talk down the market. I was there 2 weeks ago, and interestingly enough, for the first time in a long time, the property market was not on the front pages. It was more about how their ministers have been trying to steal money and have all these big allowances. But I think the most important thing is that the British press like to sensationalize everything. And when it comes to the property market, there's been a tremendous amount of bad press and how it's going to have these huge dramatic falls. And the biggest thing is that the confidence has gone out the market. I personally believe it's the complete opposite. I believe that now is one of the best times to invest, certainly since 1991. And in 1991 was when interest rates went up to nearly 15.5%. The property market devalued by about 11%. And most of the multi-millionaires in the UK that were made out of property were the guys that were buying property in and around that time, and then ultimately benefited from what happened over the next 15 to 18 years. I am a true believer that now is a fantastic opportunity to take advantage of the asset values that one is getting at the moment. And the second reason is, for a South African, is the strong value of the rand. When you look at these statistics, this here is the rand to the US dollar, and effectively what has happened over the last 5 years. This here is the rand to the pound. This here is the rand to the Aussie dollar. And this here is the rand to the Kenyan shilling. Now, you know, something that's very interesting is that even though these graphs go up and down, they've got a one-way trend. And I think what's important to understand is that while inflation in the UK is around 2, 3, even 4%, and inflation in South Africa is between 8, 9, and 10%, ladies and gentlemen, it is economic fact that the rand will continue to devalue year on year against the pound. On average, over the last 15 years, it's been about 5% year on year. So the important thing is, for a South African, you've not only got low asset values at the moment, but you've got a very strong rand. And you know, when you look at the Chinese, you know, the Chinese have one word for crisis and for opportunity. So you could look at it in a negative element, and you could say, well, the rand is devaluing and, you know, I'm losing value in my money and everything else. But I think that you need to take another component. I did a graph here which effectively took into account, this green line here is the British pound to the US dollar over the last 12 months. The blue line is the Aussie dollar to the US dollar over the last 12 months. And the red line is the rand to the US dollar over the last 12 months. And very interestingly, when one looks at it, the pound has devalued by 19.43% against the US dollar. The Aussie dollar is devalued by roughly 17%, and the rand has only devalued by 6.53%. The rand is strong at the moment. It presents you with a fantastic opportunity to be investing offshore. You know, Napoleon says the right information at the right time is 9/10 of any battle. And you know, I truly believe what we're trying to achieve tonight is to give you that information so that you can make educated and informed decisions about the market. Now, when one takes a UK overview, the important thing is that there's 7 different indices in the UK, and one needs to understand the importance of and how all these indices are put together. The one I like to use most is the Financial Times Index. The reason is it takes all property across the whole of the UK. So whether it's got a mortgage or whether it's a standalone property or being bought with cash, it takes every property into account. The Nationwide Index, that only takes mortgaged properties into account. And when one considers that less than 50% of property in the UK is actually mortgaged, it's not a great indication of the entire market. But these are the two that are spoken about most often in the press. In terms of the FT index, the average cost of a house in the UK now is £197,000. The change in the last month is down by 0.7%, and it's the 5th month now that it's actually decreased by less than 1%. And the change in the last year is now down 14.1%. When one looks at the Nationwide Index, the average cost is £154,000. May actually, for the first time since August 2007, actually saw property prices increase, and they increased quite substantially by 1.2%. And the change in the last year is down 11.3%. However, that's already improved from April, where it actually reached a peak of around 15%. Now, I think the important thing to understand here as an investor is that on a conservative basis, you can roughly say from peak to trough that the property market has lost in the region of 15%. When one looks at this overview here, you can actually see the months, you can see the house price index, and you can see that the worst point, the point where there was maximum pessimism and where the property market decreased by the most, was in November last year. Since then, it has actually been decreasing, but it's been decreasing by less every single month. And this is what I was saying. And you know, when one's trying to call the bottom of a market, the only time you can ever call a bottom of a market is within hindsight. But what you need to look at here is the trend and how the property market is still decreasing, but it's starting to decrease at a slower and slower rate. And that's important because now is when the huge opportunities are. Now is when you've got motivated sellers. But these opportunities are not going to last for long. You know, some of the developers we're dealing with are now starting to sell property again. They're no longer in the doldrums they were in from November until March. And now that they're selling, they're becoming more bullish. The great investment opportunities are no longer becoming as readily available. One needs to call it because in six months' time, we're going to look back, we're going to call the bottom of the market, and then it'll be too late to take advantage of these opportunities. So if I take you through what I think is important from this graph is that the two major fundamental things that have caused the property market to fail or to retract in the last 50 years. One of them has been unemployment, and the second one has been interest rates. Now, when one looks at unemployment, the GDP in 2007 the GDP growth was 3%. In 2008, it was 1.5%. In 2007, there were 29.4 million people in employment. It was the most ever in the history of the UK. But they've now had the worst recession since World War II. The economy has shrank by 1.9% and in the first quarter, and it's the most since 1979. Unemployment rate has risen to 7.1%. It's up by 0.8% over the last quarter and 1.8% over the last year. 29.2 million people are now in work. And the important thing is that over the last 12 months, there's been roughly 295,000 jobs lost. Now, you know, I'm very bullish about the UK market and particularly about the rental market. I've owned property there since 2002. The one thing that really concerned me was these retrenchments and the impact that these retrenchments were going to have on the rental market. So much so that 2 weeks ago, I flew over to London and went and spoke with many of the different management agents that I work over there to try and understand what impact these retrenchments had on the market. But I think the important thing, and I'm going to go into that in a little bit more detail when one's looking at the cash flow, but I think the important thing to take into account is that the Bank of England has moved fast. They've actually committed to spend £125 billion to stimulate the British economy and to try and make sure that the job losses are reduced as much as possible. But I think the most important thing to understand is that in 1991, when the property market went down by roughly 11%, it had the double whammy effect of not only unemployment and bad economics in terms of the GDP growth, but it also had high interest rates. Interest rates were at 15.5%. In the UK, interest rates peaked at 5.75%, and in 2007 we're at 5.25%. Now they're at 0.5%. You know, so the Bank of England has reacted very quickly and has made sure that the cost of capital is a lot lower, which not only stimulates the economy a little bit further, but it doesn't put huge pressure on the man in the street and effectively his cost of living. You know, when one looks here at the Bank of England rate over the last 25 years, I think the important thing is that one needs to look at the different cycles. This year was the last time that the UK property market was in trouble in the early 80s. This year was when it was in trouble again in the early 90s, around 1991. And you can see how high the interest rates were. And comparatively, this year is where it is at the moment. You can see that statistically, the interest rates are at the lowest they've been ever in the history of the Bank in England. That's a 300-year history. Now, the question you're going to ask me is, why hasn't that stimulated the property market? And this next graph shows you exactly why. When one looks at it, this graph gives you an analysis of what's happened in the US, the UK, and Australia. The blue line is how much the Bank of England or the Reserve Bank has dropped the base rate or the interest rate. So you can see here in the US, there's been a huge drop in interest rates. It's the same in the UK. But what's happened in the US and in the UK is that the banks, the commercial lending banks, have not actually passed that on to the man in the street. So even though the base rate is 0.5%, the man in the street is still borrowing at 5, 6, 7%. And so it hasn't had a huge impact with regards to stimulating the market. Conversely, when you look at Australia, even though they've dropped comparatively their base rate less than the UK and America, that has been passed on to the man in the street. And what has happened is that the Australian property market is the first world economy to be improving and actually to be in a growth phase at the moment, because the man in the street has better affordability. What that has done is it's shored up the property market. Therefore, the banks have been happy to lend at 90-95%, and it's basically stabilized the market and allowed the property market to grow. In the US and the UK, what's happened is that the man in the street can't borrow, therefore there are less buyers, therefore the property market goes down, therefore the banks are worried to lend at high loan to values, so you're looking at 70, 75, 80% loan to values. That means the man in the street has less that he can borrow. That means that there's less that he can buy, and it's a downward death spiral that effectively happens. And the only way that they're going to improve the market in the UK is that they need to pass on those interest rates to the man in the street and enable mainly the first-time homeowners to come back into the market. This graph here explains exactly what's happened. This is the transactions over the last couple of years. And you can see here in 2006, 2007, you had well over 120,000 transactions happening per month. And now you're down here in the 20 to 30,000 range. And you know, even though the property market has improved slightly, I think it's important to realize that it's these mortgages that are really constraining the market and holding it back. I mean, when you look at some statistics, in the beginning of 2007, so in January 2007, a first-time homeowner could get a 90% loan to value, and there were effectively 3,000 different ways that they could borrow money. Now there's only 103 different products. And that's very, very important. So you know, how many first-time homeowners do you know that can raise more than a 10% deposit? And then one looks at the rate. Do you know the rate that they're borrowing at now is around 6.23%, and that's with the base rate at 0.5%. And yet in 2007, they were borrowing at 6.2%, and that was when the base rate was 5%. So, you know, ladies and gentlemen, all that's happening is that the banks are not passing on the very low base rates to the clients, and that is what has happened, a huge impact with regards to the transactional volume. This graph here shows you that you can see that the transactions have decreased, but most importantly, there's been a huge decrease in the number of mortgages that have actually been approved. And that is what has caused the downward spiral with regards to the UK market. When one looks at it, the mortgage approvals are the lowest level they've been in 9 years, and they're 30% of where they were in 2007. RICS, which is the Royal Institute of Chartered Surveyors, has the lowest level of sales in 30 years, and basically the number of sales last year constituted 17% the volume of 2007. To give you exact numbers, the number of mortgages that were approved in November 2008, which we said was the worst point, was 27,000 mortgages. In March this year, it was 40,000 mortgages. In April, it was 43,000. So it is improving, but we need to take it in the context of the average. From 1993 to 2007, they were doing 98,000 mortgages a month. And one needs to just understand this, because in amongst all this chaos, there's a tremendous amount of opportunities. Because what you've got is you've effectively got motivated sellers. Now, what a motivated seller needs to do, a motivated seller has to sell the property. The problem a motivated seller has is that if there are no buyers, then they've got to drop their price. Where the fantastic opportunity lies at the moment is that there are sellers out there. There are people that want to sell property, but there are so few buyers that can get access to finance. There are lots of buyers that want to buy property, but they can't get access to finance. And because of that, those of us that have the ability to get the finance, particularly non-residents like us South Africans, where we've always been able to get 70%, we can still get 70%. Those of us with access to finance could go in and really take advantage of these motivated sellers and negotiate great discounts off the market value of the property. When one looks at it, on the positives, from an affordability point of view, as I mentioned to you, in 1990, when the interest rates were at 15.5%, the average take-home salary, the mortgage constituted 50 to 60% of that salary. And that is why it had such a dramatic impact on the man in the street. The national average over the last 50 years is 38%. And in 2007, at the height of the interest rate peak, it was 32.5%. So, this is what's important with regards to the affordability and the man in the street. But the most important thing that one needs to understand, the most important fundamental statistic, is that between the discrepancy between supply and demand. When one considers the difference between America and the UK, in America, they've basically built in the region of 1 million homes too many. So what one needs to understand is that over here, you've got supply, and over here, you've got demand. And there's 1 million houses where there's a discrepancy between supply and demand. And the only way for that to get back into kilter is for prices to come down so that you can get equilibrium. In the UK, though, it's a completely different scenario. In the UK, you've got a discrepancy between demand and supply. Supply cannot keep up with demand. And when one looks at the graph, I can explain that. And as a property investor, you need to understand that this is one of the most important fundamentals to look at if you're looking to make an educated investment with a medium to long-term objective. When one looks at the UK, the population is expected to increase by about 10% or 4.4 million people by 2021. With household sizes dropping, that actually means that they're going to need around 208,000 homes a year. Currently, over the last 5 years, they've built an average of 170,000 homes. That's 40,000 homes short, or roughly 15% a year. Now, when I was in the UK, other than complaining a lot about their ministers getting overpaid, the other thing that was very prevalent in the press was that Gordon Brown was saying how that they really had a housing problem and how they needed to bring more affordable housing to the market. He promised that they want to increase it to 240,000 homes by 2016, or a 30% increase on where they currently are. And Gordon Brown promised an additional 24% spend in the budget towards housing. The problem they've got is with the current market climate and the current economic climate, this year or last year, they only built 60,000 homes. There's a massive discrepancy between supply and demand. And every single year that this gets out of kilter, the fundamentals of the UK market, and even more specifically the London market, are really, really sound for those savvy investors that are looking to make a medium to long-term investment. Then one looks at strategies for investing. A lot of people ask me, should they invest in London? Should they invest outside London? The bottom line is that London has more growth and it has more tenants. And there was a quote on CNN that I love, and it basically said, New York is the center of the Western world, and London is the center of the rest of the world. You know, what's basically happening is that with the growth of the East, with the growth of India and China, etc., is that the whole world has had a paradigm shift, and effectively the financial capital has moved from New York to London. London is now the financial capital of Europe and is arguably the financial capital of the world. And yes, it is taking strain at the moment. I don't dispute that. But ladies and gentlemen, that will change. It will recover, and it has certainly become the center of the world. When one looks at statistics, if you take the last 30 years, you can see that London has actually outperformed anywhere else in the UK in terms of capital growth. And then if you look, basically, if I move on to the next graph, I think what's important here is that you can basically break London down into three different areas. You've got the primary markets, you've got the secondary markets, and you've got the tertiary markets. Now, the primary markets are your areas like Chelsea, Holland Park, Belgravia, the really expensive upmarket areas. The secondary markets are your Kennington, Whitechapel, Bethnal, or areas you might recognize, Wimbledon, Earlsfield. And then you've got your tertiary markets, your Lewisham, your Archway, your Brixtons. But I think the important thing for an investor, over the last 30 years, the secondary markets have outperformed the primary and the tertiary markets. This is where you're getting your best return on investment. And to give you an example of that, this here is a picture, you know, if anyone would be able to answer, but you know, this here is a picture of Canary Wharf. Those there are the towers of Canary Wharf. This is now the financial center of London. It's the financial center of Europe and arguably the financial center of the world. But what one looks at is that in that center, right in the dead heart there, you're looking at an average price of £800 to £1,000 per square foot. That is a classic example of a primary area. Very expensive, first-class property right in the heart of the financial capital. This here is called the Greenwich Peninsula. That's the Millennium Dome. For those of you that don't know, there's something like 178 concerts there this year. There's a number of restaurants, including a Spur and a Nando's. And this whole peninsula here has been regenerated. There's going to be a huge residential component, a commercial component, a university, schools, shopping centers. They are spending £10 billion over the next 10 years in terms of this area. And the important thing is with the location. That there is North Greenwich Tube Station. It's on Jubilee Line, which is the latest tube line, and it's one stop into Canary Wharf. So from a location point of view, absolutely fantastic. But this is a classic example of a secondary area, an area which is just on the outskirts of a primary area. And you know, the prices in this area are around £496 a square foot. This gives you a clear example of what one can expect with regards to a primary and a secondary area and why you're getting the better returns in those secondary areas. Then with regards to tenant demand, London far outweighs anywhere else in the country in terms of tenant demand. And you know, this isn't just the British, it's the South Africans, the Australians, the Polish, the Kiwis. Everyone comes to London to make their fortune. And you know, it's a very transient population. It can even be American bankers who are there for 2 or 3 years. Generally, they don't want to buy. They don't necessarily have the capital to put down a deposit. And so you've got a very good professional market that wants to rent property. You know, I'll give you some statistics. There's 1.4 million South Africans that live in the UK. I think some of them might have come home with what's happened in the last 12 months. But I mean, with all due respect, there's something like 750,000 of them live in London. 1 in every 11 Londoners is a South African. We're the biggest ethnic community after the British in London. And you know, ladies and gentlemen, they are the perfect tenants. They are young, they are professional, they earn good salaries, they want to live in good accommodation. And you know, I've got a rule of 10 minutes. You want to be within 10 minutes of a tube station, and then you will have good rental accommodation, good young professionals that want to rent your properties. And that is what is so powerful about the London property market and the London investment is effectively that demand from a tenancy point of view. In terms of what's going to happen in the future, you know, Warren Buffett said, I don't have the faintest idea what's going to happen in the stock market in the next 6 months, the next year, or the next 2. Clem Sunter said on the gold price, he said it will go up and it will go down, but not necessarily in that order. And I think what I'm trying to show you is that in times like this, people tend to focus on this part of the curve. They focus on the fact that the property market is going down. But you know, I'm a medium to long-term investor. and you need to focus on the fundamentals. You need to understand what is driving this market. Population growth, infrastructure growth. And yes, you've got this sector here where the property market goes down. But those people that make money in property will understand that this is the most important time to be getting into the market, to take advantage of the great asset values that you can buy at. And I think, you need to understand the investment strategy. That there is my very first house. I bought that in 2002. Now, a lot of people look back in 2002 and it was just another year. But for me, that year was just after September the 11th. England was going to war with Afghanistan. Oil prices were going up. Inflation was going up. There were economic problems. And all my friends said I was absolutely crazy to be buying a house. I said to them, I disagree. I will put tenants in here. My rent covers my mortgage with a bit of a buffer. And I will sit back and enjoy the ride. If the property market goes down, so what? I will continue to rent out that property, and when it recovers, I effectively will still have my property. Because, you never lose money in property unless you sell. Ladies and gentlemen, I look back now and that property's been an absolute gem. It basically, my rent is about £2,400 a month. A year ago, my mortgage was £1,750, and now my mortgage is around £475. You do the maths in terms of cash flow positive property. That is what I focus on. I focus on areas with good rental opportunities, where there's good rental demand. And if you can focus on that rental opportunity and you focus on that income, you need to focus on properties where it's cash flow positive. And then, ladies and gentlemen, you will not worry whether the property market goes up, down, left, right, or sideways. The important thing is that now, amongst all this opportunity, you're also buying off a very, very low base of where the property market was. And what will basically happen over time is that when the market recovers, when the banks start lending, that property market will recover. And what will happen is if you bought off a low base, you will get tremendous growth on your asset. But the important thing is to focus on the income. When you're in this period here, when you don't know when that capital growth is going to take place, or by how much that capital growth is going to take place, you focus on the income. And that is where you need to focus on areas with good income demand to make sure that you're getting the best return on your investment. And that will give you the insurance and the peace of mind to make sure that your investment has a good medium to long-term objective. When one looks at the cash flow, I spoke about it a little bit earlier. As I said to you, I went there 2 weeks ago to find out what was happening. The London market, month on month, has seen rents rising by 0.4%. The average rental now is £1,630 per month. But what I found there was that despite the recent growth in rental prices, the London market is far from recovery. So what I found from talking to the management agents, you need to focus on the good areas, and you need to focus on areas where the rental will be less than £2,000 per month. Overall, the rents have dropped by 6.6% year on year from May 2008 to May 2009. But interestingly enough, the three best areas to be investing in terms of rental demand is Barking and Dagenham, Hillingdon, and Greenwich. Ladies and gentlemen, it is no coincidence that IPS is suggesting and recommending our clients to be investing in Barking and in Greenwich. And this is from a website, findaproperty.com, which is basically, it's their residential index, and it's one of the biggest property portals in the UK. What's also interesting is that the average rental yield in London is 4.74%. Investors are continuing to see better returns in London's outer boroughs. So once again, those secondary areas are the ones where you are getting the best returns. And an example of those, you're getting yields in excess of 6% in Barking and Dagenham. I'm going to show you an opportunity just now where we're getting yields of between 6.5% to 7%. And that is what one needs to focus on. And when one looks at the areas where you're not getting the best yields, it's those primary areas. It's Kensington and Chelsea and some of the affluent southwest areas like Richmond upon Thames. Kensington and Chelsea have actually seen that the yields are now at 3.92%. And their yields have actually decreased over the last 12 months. So, it gives you a classic example of one of those primary areas and one of those secondary areas, both from a capital growth point of view and from a rental point of view. In terms of the overseas investors, something that certainly we've seen a huge trend is that overseas people have been buying into the UK. And the reason being, as I've mentioned to you, is that they recognize the great asset values of the investments, and also the weakness of the sterling, so that their currency is buying them more value. And they're taking a medium to long-term view and with the idea of holding the property. 1/3 of transactions in the last 3 months have actually been from international investors, and IPS has helped a number of particularly South Africans. To give you an example, there's been a number of investment shows out in the Hong Kong recently, and millions upon millions of pounds of investment have been made into the London market from those people. There's been good investment from Dubai, and there's also been good investment from South Africa, with people taking advantage of the strong rand. When one needs to understand the foreign currency, if you look at it as a South African, if you take the last 15 years, there's been 400% growth in South African property over the last 15 years. There's been 182% growth in the UK market. But if you had invested the exact same amount of money in the UK 15 years ago in comparison with investing in South Africa, you would have 240% more money now. And that is what, as a South African, you need to understand, because it is so critical. Let's look at the numbers with regards to a cash flow. I'm going to take one of the one-bedroom units, which we've effectively got at the moment in Barking. And I think the important thing is that if you run through this, this is a very standard way that I put all my cash flows together. But here you can work on a 70% loan to value as a non-resident. If you're living in the UK, you're looking at between 80 to 85%. The yield on this property, you're getting a rental per month of around £758. That's a yield of 6.23%. You've got a rental escalation. I've put in a void period there. Your interest rate is around 4.5%. And the purchase price of a one-bedroom is £146,000. There's no stamp duty, because this property, anything below £175,000, doesn't have any stamp duty. There's furniture and flooring. If you're renting out in London, you have to rent it out fully furnished, right down to the knives and forks. You've got the finance fees, which are the bank initiation fees. You've got the legal fees. Now, what the nice thing in the UK is that you've got a lawyer that acts on behalf of the seller, and you've got a separate lawyer that acts on behalf of the buyer. So that lawyer, you pay him, he protects your rights and makes sure that everything is done by the book for you. You've got your service charges, which is like your body corporate fees. You've got your ground rent, your lettings and management, and then I've put in the exchange rate at yesterday's rate, which is 13.13. The next box, this box here, gives you your total capital outlay. So you can see your purchase price, that's your mortgage at 70%, and this here gives you your total capital outlay. And the only one that I haven't spoken about, it's quite common in the UK, and it's certainly something you need to keep in mind. They often don't include the flooring. So it's about £500 per bedroom. So on a one bedroom, I've put in £500. There's an amount there for £2,000 for completion costs. That's not being paid to anyone. I just like people to have a float when they get started, you know, to if there's anything that needs to be done. So it's just a nice buffer, basically. So the total amount of money you need to be able to buy this property is £53,000. The timing of this property is that basically to reserve the unit, you would need to put down 20,000 Rand. We would then work with the lawyers and the solicitors to exchange on the property, and this is a tight time scale. When you're dealing with a motivated seller, we need to move quickly. We've got 12 weeks to do the entire transaction. So we need to exchange on the property and put the first 15% into your lawyer's trust account. Then in about 10 weeks' time, we need to put the remaining 15%. So that just gives you a rand amount and when that money would actually be due. But I mean, holistically, you need to understand that you're going to need all that money within the next 3 months. We do have projects where the lead time is 2.5 years. You only have to put down 2.5% now, 2.5% in 6 months, and 5% in 12 months. So you've got a lovely long lead time, and it's much more cash flow friendly. And then, you know, what I believe is the most important part is the cash flow. You've got the rental income minus all the expenses. You can see that I'm quite conservative. I've even put in a sundry amount there. But the most important thing, this property is really nice cash flow positive. £1,800 this property is going to make you after all your expenses. And then when people say to me, what is the growth? What can one expect? And you know, I don't have a crystal ball better than anyone else, but I've taken a 5-year view and I've worked on 3 scenarios, 3, 6, and 9. The reason being is that property, even when it's in a downturn or going sideways, tends to track inflation. And inflation over the last 5 years has been in the region of 3%. Basically, the average growth over the last 50 years has been 9%, and in the middle has been 6%. So if you take a 3% capital growth over the next 5 years, you're getting a 7.99% return on your money. It's not fantastic. That's a year-on-year return. It's not fantastic, but it's certainly better than keeping your money in the bank. But the important thing for me as a South African is that with you buying off a very low base, one needs to start looking at these sort of numbers over here in the medium to long term. But then as a South African as well, you've got to take into account the devaluation of the rand. Roughly 5% year on year for the last 15 years. And that, as I explained earlier, is economic fact, while our inflation is higher than the British inflation. And at a 5% devaluation factor over 5 years, at only a 3% capital growth ratio, you're making a 25% return year on year on your rand investment. So to compare apples with apples, if you take R1 million and invest it here in Sandton, or you take R1 million and you invest it in the UK, you're making a 25% return. You're getting that rand hedge, you're getting that insurance policy, you're getting that offshore asset, and most importantly, you're getting that offshore income. And I think it's so important to understand that as a South African, and to understand that is why you should be looking at investing offshore. You know, I'm a big believer in South Africa. I want to live here for the rest of my life, and I hope that my family's generations live here. But I think it is wise and prudent to be investing some of your wealth offshore. And it needs to be in a first world currency, in a first world asset, with a first world income. And it provides you with all those opportunities. And hopefully those numbers speak to you and explain why I'm so passionate about understanding those opportunities. If one was to look at it, you know, this next graph here, basically this analysis, and I can send it through to you, but I think the most important thing for me is that you want to be building up a portfolio. I want to continue to buy properties in the UK, and it's not just about the capital growth. This property after 10 years will be netting me £29,000 a year. You know, ladies and gentlemen, at today's exchange rates, that's over 400,000 Rand a year. You know, I could happily live on that. And yet, if you go and buy a couple of them, imagine what it can set you up for in later life. And that's without taking into account the capital growth. If you take into account the capital growth, you know, at an 8.5%, which is below the 50-year average of 9%, you'll have £426,000 in equity. Put that into Rand terms, you know, you're looking at between 5 and 6 million Rand. And I think that is what one needs to understand. That is the end goal. That is why you're investing offshore, is for the medium to long term. This here is a development called the City Peninsula. It's the one that I explained to you in Greenwich, close to Canary Wharf. You know, a year ago they were trying to sell it at £650 a square foot. With what's happened in the whole market, we were able to go back and seriously negotiate with the landowner, and we brought it to the market at £496 a square foot, or a discount of 26%. The other nice thing here is the lead time. The property is going to be built over the next 2 years. They're actually going into the ground now in July. You basically put down a deposit of 2.5% now, 2.5% in 6 months, and 5% in 12 months. You only have to put down the remainder of money in the middle of 2011, and then there's a rental guarantee for another 12 months, which takes you right through until 2012, which is also the Olympic year. And then the opportunity that's hot off the press, last weekend there was a fire sale in London. A developer basically had sold the entire development to an Irish consortium of investors. They've reneged on the deal and walked away. Hopefully you saw the email that we sent out today. So what the bank did is they said, right, we are going to repossess all these properties, all 190 properties. And the developer said, no, let me go to market. So last weekend they did a fire sale and they sold between 40 to 50% discounts. They had 1,000 people come through the door. They had 150 people sleep the night over, and they sold 190 properties on the day. Developers have understood this. There's another opportunity which they're doing next weekend in London, and basically we've been able to access it for our investors 9 days before they actually do that fire sale. To give you an example, it's in Barking, which is right, you know, in northeast London. It's right near the Olympic Dome, and a price of a unit in 2008 for a one-bedroom was £197,000. That price today is £146,000. For a two-bedroom, it was £239,000. That same unit is now selling for £169,000. That's an average of between 35 to 41% discount. These properties are ready today. Within the next 12 weeks, you would take ownership of these properties. There's a very good rental demand in this area. And as I showed you earlier, Barking is the #1 performing suburb or borough in the whole of London with regards to rental demand and rental growth. You know, I can't emphasize to you how big this opportunity is and why you need to be acting. And if you've got our email, get onto it, read it, or contact IPS to find out about this opportunity. In terms of an end-to-end solution, we can help you with the financing. A gentleman by the name of Mike Abbott from Sable Wealth. We've got someone that can help you with offshore structures. Someone asked the question, if you go to my website, there's a full presentation by Philip Maviers on how to set up offshore structures, how to use them to make sure that you're tax efficient, and really I would highly recommend going and looking at that on our website. The process, as I explained to you, you put down 20,000 Rand, you sign a reservation form, you then exchange with Mike Foss, who is your lawyer, and then we've got foreign exchange guys that can help you move money overseas, and then you need to put the money down in terms of the deposits. We provide you with an end-to-end solution. We've even got a management solution to make sure that that tenant, that property is looked after, it's managed, and it's maintained. We aim to help you invest with confidence. That is our primary objective, so that you can invest long distance with confidence. Know that you've got a good asset with a good income. And then, in terms of the opportunities, I focus tonight on investment and apartments, but we've got an array of solutions we can help you. We can help you find individual homes. We can help you find repossessed homes. We can help you find homes that need to be renovated and then provide you with a renovation solution. We can negotiate on bulk discounts. We've got a unit in the northwest of London at the moment. It's an 8-unit development where we're negotiating. And then we can also help you with commercial opportunities. So no matter what it is you're looking for in the UK market, we have a solution for you. There's a good old South African saying which says, "Ver van jou goed, nou aan jou skade." And you know what that basically means, and forgive me, I'm a Natal boy, so my accent isn't too good, but it basically means that we're nervous to invest away from our heart. And the important thing for me as a South African is that, we provide you, we give you all the information so that you can make that investment. And what is most important is that you can take advantage of those opportunities overseas. And I really think it's important to understand that we have that end-to-end solution and that we've helped over thousands of investors invest internationally. Lastly, I asked the question why I thought it was the best time to be investing in the UK market, certainly since 1991. In a recent Knight Frank report, they said that the market will be fully recovered and be growing again properly by 2012. The fundamentals are in place, and as soon as the banks start lending to the man in the street, that is when we'll really see the wheels of industry starting. You're getting real value at the moment. I pointed out to you that from peak to trough, the market has lost in the region of about 15%. If you're buying at discounts of 26 to 40%, even if the property market was to lose another 5%, you're still buying it below market value. And then lastly, as a South African investor, the Rand in September last year was 15 Rand to the pound. It's now 13 Rand to the pound. And this is summed up by a report. I got this recently, literally last week, from the RMB Private Banking. And what they basically had to say was in terms of their currency. They went through a number of different factors in terms of the Rand and our economy. And they said they're quite bearish in the medium-term view about the South African Rand. And they've adjusted their forecast to take into account these. They expect the US dollar to South African Rand at the end of the year to be 9 Rand to the US dollar and to be trading between 7.50 and 10 Rand by the end of 2010. It will be looking around the 10 Rand zone. So the bottom line is, and it says it there in red, and they said it to all their clients, if you're looking to invest offshore, now is the time to do it. Ladies and gentlemen, that's so important, I'm going to repeat it. If you're looking to invest offshore, now is the time to do it. And I leave you with a little question. A lot of people say to me, well, the property market might go down by another 5 or 10%. I say, sure, it might. But the question I ask them, and I think it's equally as important, do you think there's more chance of the property market going down by another 5 or 10%, or the Rand devaluing in the next 12 months by 5 or 10%? Manage the risks you can control and understand why now is such a fantastic opportunity to get into that UK market. So, in conclusion, I pretty much want to leave you with this little saying by Van Gogh, which I love. Whatever you can dream, begin it. Boldness has genius. power and magic. Begin it now. Ladies and gentlemen, we've had so many people sitting on the fence for the last 8 months, and yet the opportunities have been phenomenal. I've been telling people that. And you know, ironically, 6 months from now, these opportunities won't be available anymore. And then people are going to look back and say, I wish I did. It's going to be exactly the same as 2001 here in South Africa, where everyone looks back now and says, I wish I bought property knowing what I knew in 2001. Ladies and gentlemen, don't make that mistake. Get your offshore asset. Get your offshore income. Get that insurance policy. And most importantly, give you that peace of mind of owning a first world asset in a first world currency. So now we move on to question time. And before I go on to question time, a bit of extra incentive to go to our website. We're giving away 2 tickets to the British Lions versus the Springboks. It's free, so go online. For those of you on that are on the seminar and not on the telephone, I've just sent you through the website, so it's nice and easy. You can click on it. Go there. There's a tremendous amount of information that you can find out. I really do hope that has answered all your questions. Please give me your questions. How can I help? I showed you earlier on how to go online and effectively fill in a question. So send me through your questions. I'm sitting here waiting. Hopefully I'll be able to answer those questions for you. Certainly from my side, I hope you've enjoyed this evening. I hope it's given you the right sort of information to make an educated and informed decision. And most importantly, hopefully you've understood those opportunities that are available. Ladies and gentlemen, I'm sitting here now. Does anyone have any questions that they would like to? Fire them through. All you have to do is type them and I'll be able to answer them for you. I know this is quite new technology, and certainly, we've been using it for the last couple of weeks, but we're not seeing that many people are actually using the technology. Let's get you a bit more interactive. What are you actually looking for at the moment? Let's launch this poll. So I've given you there. Tell me what you're looking for. What is it that you would like to get involved in the UK market? All you've got to do is actually click on the option that you like. I'm going to give it a few more seconds. I can see that a couple of people have voted. Okay, let's I don't know if anyone else is going to. Let's close that poll. So quite interestingly enough, if you want to see the results, I'll put the results up for you. And you can see there that 67% of people are looking for developments with long lead times. 67% of people are looking for stuff that's finished. And 33% of people are looking for standalone residential investments. So very interesting in terms of what people are looking at. Another one that I'd be interested in is which areas would you be looking in? So if I was to launch this poll, where would you be looking at, and which sort of property markets would you wanting to look at? Okay, we've got some answers here. Let's close that poll and show people where we're looking. I'll share the results so you can see what I'm looking at. Very interesting, in terms of what one's looking at. Okay, so I've got some questions here. Let me just open up this question box. I want to be able to answer some of the questions. Right, the first one is, how much deposit does an investor need? Lee, it very much depends on where you're living. If you're living in the UK, if you're looking to buy and actually live in the house, you would need about a 10% deposit. If you're looking at it as a buy-to-let investment, you would need about a 20% deposit. And if you're living in South Africa, you would need in the region of about 30% deposit. So that hopefully gives you an overview in terms of what you're actually are looking at. Hopefully that answers your question. In terms of arranging finance, something that a lot of people asked for, the great thing in the UK is that they are asset-based lenders. They do take into account the value of the asset and the rental income of the asset. Unfortunately, what has changed over the last 12 months, they do also look at the individual behind the asset to make sure that they've got the affordability to be able to own the property. So, it is something that takes into account. It very much depends on the property. I tend to say to people, if you're earning more than £20,000 or 300,000 Rand a year, then they're more interested in the value of the asset, but they do still want to know who the individual is behind the property. So, that's just an interesting, example, basically. Ladies and gentlemen, we're coming up now close to the hour, which is what we don't want it to run over the hour. From your perspective, are there any more questions that I can answer? I've got another one here from Lee. Let me just see this one quickly. It says, my parents live in the UK and are looking to buy a property. They have saved £100,000. Would you recommend to buy one property or a couple? I think, Lee, the most important thing is that is everyone's individual perspective. Certainly from an investment perspective, you could actually get very efficient with regards to both the taxable income. So you need to take into account what the taxable income is, you don't want to earn income and then have no interest to be able to offset against that income, because effectively then you'll pay tax on it. But your parents might be in the situation where they want to live off the cash flow. I would highly recommend you getting them to contact me. I can run some scenarios. I can show them how they can get the best growth on their investment, but also make sure that we find the best solution with regards to what they're looking for. So hopefully that answered your question, Lee. Dylan Burke has sent through an email here. He's basically asking just with regards to the different solutions. I think the important thing is that if you want to look at any of those different solutions, send me an email. I can put you in contact. We've got a number of different service providers in the UK, and very much depending on what you're looking for, they can actually provide you with that solution. So hopefully that answers it, even down to commercial and sourcing commercial opportunities. Ladies and gentlemen, I want to finish off. I'm sorry, I've got another 2 questions here. What, in your view, is the best type? Hang on. I'm just the best type of unit to purchase, a 1-bed studio or 2-bed? Look, again, that's a very interesting question. A lot has to depend on the individual circumstances. What I tend to find is that certainly from an affordability point of view and a medium-term cash flow and capital growth perspective, the studio and the 1-bed will grow quicker with regards to capital growth, just because they're more affordable and there's more people in the market that can afford to buy those properties. However, from a yield perspective, a 2-bedroom, certainly a 2-bedroom, 2-bathroom, what you'll tend to do is you'll put 2 young professionals in that property and you'll tend to earn a higher yield. So over the medium to long term, a 2-bedroom, 2-bathroom will get you a better long-term return, taking everything into account. But in terms of short-term capital growth, a studio or 1-bed will be able to get that. So, it very much depends on what you're looking for in terms of your actual portfolio. Ladies and gentlemen, just before I finish off, because we are coming up to the hour, I want to ask you one last question. We're looking at putting together a fund opportunity where we will actually go out and, like this barking opportunity of 35 units, we'll go out and we'll buy the entire development. We will allow you to get into that opportunity with regards to, as long as you've got £10,000 or more. So you'll have the benefits of what the multi-million-pound investors have, but yet it'll be on a smaller capacity. It'll be helping the man in the street. And my question to you is, would you be interested in something like that with regards to looking at it? How much would you actually want to invest in terms of that amount of money? And that poll should have actually come up now. I'm just looking at it, sorry. I'm also learning this technology every day. Anyway, okay, that's not going to work. I think we've got there, in terms of the poll. Okay, we've got that one in terms of below market value. And then, sorry, the last one that I wanted to put up was, what sort of capital would you want to invest in that and I think, the reason I ask is because obviously we've got investors that want to put in £10,000. I met a gentleman today that, wants to put in £5 million. And obviously it's very different for everyone, but it just gives me an indication of what the type of things people are looking at. Okay, well, that's very interesting. We've got a mixture, a lot of people going for the £10,000, a lot of people going for between £10,000 and £50,000, and a few people going for over £100,000. So I'd like to thank you very much for your time. I've got enough time for one more question if anyone wants to ask the question. We've got 30 seconds left on the clock. Is there any more questions that anyone would like to ask? No? Okay, fantastic. Ladies and gentlemen, I'm going to leave it at that. I want to thank you so much for your time this evening. I really hope we achieved our objectives of providing you with information so that you can make educated and informed decisions. As I said to you, there are fantastic opportunities at the market at the moment. You need to understand these are not going to be there forever. Do the maths, understand the situation, and when you're ready, IPS has your solution. Go to our website, www.ipsinvest.com. We can help you out, or give us a call. Our Joburg number 011-463-0588, or our London number 0208-971-3245. I want to thank you very much. I want to thank you for your time. Have a fantastic evening, and I have to add this in. Good luck to the Springboks. Hopefully they give the British Lions a good hiding this week and for the rest of the series. Thank you very much. Thank you for your time.